very warm welcome to the Trading Bell show. What a year it has been, and that's what we wanted to focus on, to look at how the year has behaved, especially in regards to the markets. And joining us to help us more to understand this is Kevin Gigi, who is the head of equities at Jengis Capital, right here on my right. And my far right is Samuel Gishohi, NCBA Investment Bank. He's the head of business right there. Thank you so much, gentlemen, for coming. And I want to start by saying, this year has been what has been by many times unprecedented because of the nature of how it is, from the pandemic we are seeing, from the many things that we are seeing, political temperatures rising. But I want to ask you, maybe generally, this year, what has been your observation from where you sit? And maybe I'll start with you, Kevin. In brief, what would you say?
It's been a tough year. It's been a year in turmoil. We've seen quite some things that have really affected capital that flows into our markets.
Yeah.
So one, of course, there's the pandemic, which was carried on from last year. In addition to that, we've seen all these geopolitical instabilities. We've seen almost all our neighbors in an issue or two.
Yeah.
We've seen Uganda, invade DRC. We've seen the Tigrayans and Ethiopians. We've seen the Somalis protest after the election results. We've seen a coup in Sudan.
Yeah.
So you name a country, early in the year we saw, Tanzania's president die.
Yeah.
So I think it's only Kenya that has been stable in the region, but everything else around us has really played into affecting the capital inflow into our country. So it's been a tough year, and hopefully the next one becomes better.
Okay, and of course we'll be delving more, especially on your observation on the equities later on. But Samuel, I know you also sit in a desk where you see a lot of things. How has the year been on your end?
Well, it's been quite interesting.
Yeah.
2020, unexpectedly, we saw quite a lot of inflows, especially from the retail end, which I deal with mostly, because a lot of working capital became idle.
Yeah.
So against our expectation of, a lot of sell-offs to support business, it
and
was
by the way,
opposite.
I hope you mean 2021. Because
No,
2020.
I'm coming to 2021.
Okay, fine.
So, and that was when the market was at its lowest of low.
Yeah.
So 2021, we saw quite a bit of a recovery, especially on the large caps.
Okay.
But if you look at the the all share index, it actually increased more than the NSE index, which means across the board, there was a recovery.
Okay.
However, the large caps came back very strong, particularly the banks and telecom.
Yeah.
And around October 2021, that's where they peaked.
Yeah.
So, in as much as we are currently in a bit of a stagnation and a bit of a dip because of a lot of profit taking, a lot of people did laugh all the way to the bank because they took the brave step of buying into the market. So, 2021 was a recovery year.
Yeah.
Of course, we're going to an election year, so then there's a bit of a worry about that. But generally, 2021 has been a surprise, for lack of a better word. Yes.
Maybe we could also attribute this to the advancements we have seen, like the vaccination processes that have come across and all that.
Absolutely. The reopening of the economy, of course, as the the COVID-related lockdowns and curfews and all that stuff started to ease off, then businesses have started to pick up. But even in as much as businesses, because the economy didn't really pick up, the stock market itself remained a sort of haven. Now we are seeing a bit of flight of capital back into fixed income, which is bonds, the bond side of things, primarily because the stock market has sort of hit a bit of a peak and has dipped a little bit. And so people are putting a bit of money in the safe side, especially with the shorter end of the yield curve going up. Interest rates are going up. The government is quite hungry. So there's good yields there, which the investors are sort of taking advantage of.
Great. Before we just focused how we expect to see the year, next year to be, Kevin, I've seen, looking through, especially this year, from Q1s all the way down, banks were smiling because I was seeing a lot of good reports coming out, and I think it's alluded to what, we're just hearing about the recovery. I don't know, what's your comment, especially on the banking sector, because it looks like it's the one that was really smiling. I didn't see any banks saying we just hit some losses.
Yeah, I mean, the base was really low where the banks were coming from, and that is 2020, especially if you look at the full year, yeah? It was a full year under the pandemic. So having set the bar so low and the country becoming more reopened in 2021, I think it got to people where guys in okay, this thing is not coming and going, it's coming to be with us. And so guys, some folks started taking preventative measures seriously. We started getting some vaccines into the country. We started training more people to be more equipped to deal with it. So generally there was that sense of relaxation, and guys just got back to their usual businesses. And now once businesses peaked, personal loan consumption's peaked, of course it was all smiles for the banks. So yeah, we've just from seeing, if you look at all the results, Q1, Q2, Q3, and now we're going all into full years, you'll notice that the banks have really reported improved loan book. Some are converting their government securities now into available cash to loan out to the public. And as much we expect, personal businesses, consumption, especially going into a festive period. We expect consumption, next year, early next year again, kids are back to school. So all this is manufacturing and consumption, and that's all that is fueled by capital that is provided by these banks.
Gishwahe, I want to throw you as well in the bus there about the banking industry. What does this mean now for investors? People who are eyeing to, buy a stock or two. What would you tell them based on that?
Valuations are low. Which is a good thing. And the recovery is not yet fully round. I mean, if you look at the likes of KCB, which were around 55 before the pandemic, went down to 32 or 33 there, and have come back to the late 40s, 47, 48. We still have quite a bit of way to go. Valuations are low. The performance is very good. We are coming from a dividend drought. If you look at Equity didn't pay dividends, Barclays didn't pay dividends. So there's quite a few, INM I think didn't pay. So there's quite a few banks who didn't pay dividends during the pandemic period. And my feeling, or our feeling, is that going into now 2022, we are going to see them come and use dividends as a signal. It's called a signaling factor to say we are back. Things are good now, because they are doing very well. So given that, I would expect that any investor is looking and seeing that the yields on stocks, if the share prices, which is now the capital gains, start to pick up in 2022, and of course the dividend yields are good. We are assuming 8-9%. Probably even higher if they're going to be trying to make an impact on what they didn't do in 2020, 2021. It would mean a very good year for investors to be buying now. Now, the other thing I would say, going back historically, and it doesn't mean that this will be the case this election year, but every election cycle, for the last 4 election cycles, the market has rallied by more than 20%. Go and look at the graphs, the NSE 20, you'll see. That's interesting. So if that has been the case, and that's because during election years, investors are not looking to put too much in their businesses, because there's a bit of, and so the tendency is for this money to go into the stock market. My worry is that because COVID hit 2 years to the election, that may have already happened. So it may not necessarily happen, but it's a possibility that we could also see a rally next year.
Interesting, you've already jumped into how we're looking at the forecast. Kevin, I want to bring you as well in. What's your, from where you sit, what's on your crystal ball? What do you see 2022 being like?
I think
that doesn't look nice. Go on.
It's I mean, no analyst can comfortably predict what an election year could bring. I think it will be more of a surprise to us than how we were caught flat-footed with the COVID pandemic. So every election is different, and they all have their own dynamics. But I think first and foremost, and it's my prayer also, that it will be a peaceful election. I think the candidates are pretty clear. And it's my only worry is that it seemingly, as the time goes by, it seems to be a two-horse race. And that's when we have now issues, of course, winner takes all and loser won't accept defeat. So there are those concerns, and I think if you talk to every analyst, they'll tell you they're pretty concerned about that fact. But my prayer is that we've also learned from the previous elections. In terms of foreign direct investments, it's foreigners tend to keep off from the market during that period. And as such, we might see sort of like a temporary freeze on the stock exchange. Yeah, we are in a market where north of 85% we are driven by foreigners. You know, our market is not like Pakistan where 92% are local, so we cannot support our market by ourselves. So once these foreigners look out, and you know, to Gisho his point is we have seen quite some inflows into the stock market, and that's also primarily because our regional neighbors are pretty unstable. So if anyone is looking to invest in an African fund, those African funds, and they're looking to invest in East Africa, they'll predominantly look at Kenya because we are heading the region. And we are not faring too bad when you're looking at the continent as well. We are a top 4 economy. I was just looking at the African Stock Exchange Association, ASEA, you know, and you'll realize Nairobi Stock Exchange is almost in top 3 on all statistics, you know. In terms
Quite
of
impressive.
Equity turnover, number of trades, all those metrics. So you know, you'll find your Cairo Stock Exchange over there, and these are 27 stock exchanges. You know, there are 28 stock exchanges in Africa. So these are 27, which means it's ex South Africa. So we are doing fairly very well. You know. So the next year will for me, I think we've learned from the past, and guys seem to be well positioned now. You know, guys have understood that we need to invest more than we consume, especially so that you don't get flat-footed. As Gishohi mentioned, the valuations are pretty impressive. You know, you're looking at KCB at 43, you're looking at equity at 47. You know, you're talking about Safaricom at 37. These are stocks you'd think rally to 43 levels. And with the benefits or the dividends of South Africa expanding regionally, we've not yet seen that. Of course, unfortunately, because they went and expanded into, you know, we're talking about 50 billion Kenya shillings for a license fee, expanded into Ethiopia, then Tigray happened. So we've not really seen those dividends come to play. And I think once, and our president is playing a key role in advocating for peace on that Horn of Africa. I think once that settles down, we're going to see quite some dividends in the blue chip and more so on Safaricom.
Speaking of which, we'll be talking about how the blue chips are behaving, especially in the moving direction. And, you know, Gishohi, I want to end this part, but I want to ask you quickly, I have seen a lot of interesting things happening through the exchange this year, and I think we'll delve more on that from the day trading. I've seen even the bonds market getting a bit excited, corporate bonds as well being released, and we've seen 2 successful ones. I'd like you to comment on that, but right after this break. So welcome back, you're watching The Trading Bell, and I'm here with Kevin Gigi and Gishohi himself all the way, just helping us to understand the year, how it has been, and what are we seeing as we cross over. We are talking about the interest we have seen on the corporate bond sector, talking about what we saw with Family Bank and EABL. Gishohi, I don't know, what's your comment on this? Is this a new rise that we're seeing with interest from investors?
Well, I think investors looked more at the quality of the companies that were issuing the corporate bonds. We've seen a corporate bond drought for quite a while. And of course, before that, we saw quite a few corporate bonds that went bad. I think there was Chase Bank, and there was Imperial Bank. And so investors had become very averse to those. And so I'm glad that we did see oversubscription and a very good response of investors to those 2 corporate bonds. Means there is an appetite now, and of course, if they're well structured, it could be a good thing for that market. Of course, there's still that worry corporate bonds are very illiquid on the secondary market, and so we hope that this new surge will also help to see more activity on that end.
And it's also a way to, I think just for me, it's also a way to diversify. Because if you look at investment funds, they're predominantly in 2 things. So they're in the stock exchange, or by that I mean equities, or they're in government securities, government debt. So traditionally we had seen a couple of good bonds, especially from EABL, Then they went for a time where they sought other funding channels. So we saw quite some drought. Then I think the last few corporate bonds that again we had, as Gishohi mentioned, we had Chase and Imperial and a few others went bust. So guys were really, because the level of trust that you bestow to corporate bonds is not the same you give to government debt.
Yeah.
Government debt is backed by the sovereign, you know. Corporate bonds, you can only go for so far before you're wiped, yeah?
Yeah.
So with the back of companies, again, such as ABL in the last few years, and now, you know, Family Bank and a few others, I think there's just that investor optimism and hope, and also a way to diversify from the two classifications of investments.
So we are likely to see some more next year.
We
Hopefully.
could see some more, and it's a cheaper way for them to also finance. You know, if you're going to a bank at 13.5%,
yeah,
and you can get it from the market at 11%, I mean, it's cheaper for the companies.
All right, so I just want to start with you, Kevin, to comment about this day trading. We saw the launch of day trading right here. Apparently, from hearsay, it's a game changer in itself. I don't know what has been your observation.
Game trading was poised to be a game changer. To me, it hasn't really come close.
Not
you know,
yet.
it's all the, you know, the excitement and hula baloo about a new investment, but it doesn't really take off from where we're seated.
Yeah.
So we earlier on saw derivatives.
Yeah.
If you look at the turnover derivatives, I mean, it's ludicrous. It's a joke. It's neither here nor there. Derivatives market is one of the biggest markets in the world.
Absolutely.
I think the biggest market in the world.
And how are we doing here?
We're not doing quite well. You know, we're talking about 200,000 turnover a day. When you go to the market, we're talking about trillions of dollars in turnover a day. Because almost everything can fit into a derivative, and that can become a commodity. You know, so it's a very big market out there. It's a really unexplored market in here. Yeah. Partly or in part, it's because, you know, we have very countable securities, you know, the single stock futures and index futures, and that's just about it. You know, we have a gold trading on the main board. We don't have a derivative for that.
Let me bring in Gishohi on that, because what should be the call to action? Because, you know, the instruments are there. Why are people not really excited about taking these things up?
One, the biggest issue is the level of sophistication.
Okay.
We are coming from a market where a majority of investors are dividend-related investors.
Yeah.
Very few investors are actually sitting in what we call pooled funds. Most investments are individual retail CDSC accounts. I mean, we have about 1 million CDSC accounts in comparison to South Africa, where there are very few, much less in the number of CDSC accounts, because they have a lot more in terms of pooling of funds, which now means that the fund can diversify into different, you know, the different securities, and with some underlying knowledge of the market, because it means it's being managed by somebody who understands the market. So I think a lot of investor education about these things is important. Kenyans don't pick something new like today and tomorrow they're running for it. They're usually very, very cautious with any new investments. Remember, we have we have seen so many scams in Kenya, and Kenyan investors always feel that anything new until, yes, unfortunately. So it's not very easy. We've been talking to our retail investors, but you will always find that feeling of, okay, let's wait and see.
Let's get into the week-to-week look at how the markets performed over this week. And Gishohi, I want to start with you. I'm looking at the top gainers. I'm seeing interesting names here. I'm seeing Sasini, Nairobi Business Ventures, Umeme, BK Group, Jubilee Holdings. These are not the usual top movers that we would expect, but what's happening in these top gainers?
It's usually a sign of stagnation.
Yes,
when the big boys are not really moving up or down, it means that the market has stagnated, so they're not being the top gainers or top losers. And so investors start to look at this, you know, you start seeing the investors who are trading in the smaller, you know, smaller, probably less volume, lower volume stocks, starting to take a front seat. And that's usually what would happen between November, December and January. Because of course now funds are looking it's holiday time. Everybody is doing something else with their money.
Okay.
Yeah.
So top losers, Kevin. I'm seeing also very similar ways. I'm seeing Samia, Standard Group, Car and General, CIS Insurance. Your comment on this?
I think for each and every single name that we mentioned there reported losses, or at least a decline in profits, and a good number of them reported numbers in the red.
Yeah.
So it's been a tough year, especially for media, for insurance, with all the claims that have been coming. You know, media with all their operating expenditure having shot up, and with traditional media relied on print media. The new consumer is consuming digitally. So I think that has been a big hit on media companies like the Standard.
Yeah.
So, but again, as Gishohi mentioned, you'll notice that some of these new names that you see on either the movers or gainers will be there on significantly low volume, 1,000 shares, 200 shares, but they're only, because they're pretty quiet counters to trade. And so once they trade a shilling less than the previous closing price, you find they're 9.8% and you think the company is going to bust. Not really.
Okay. Gishohi is the one who's very optimistic today. So the indexes look like they're doing well. I can see the all share index is up by 3.54%, even NSE 20 share index as well, 2.22%, 25 share index as well, 3.83% up. What's happening as well in the indices?
Well, 3-point-something% is really nothing significant. But when I go back, we hit our peak around September, October.
Yeah.
And we've seen quite a bit of a downturn on the indices, which tells me that now, because that was a lot of profit taking. So now market is back where we would be telling people it's a good time to take bargains.
Yeah.
If you have some, idle money, or we call it disposable income. Yes. Let's not call it idle money. Yeah. If you have some disposable income, this is a good time to pick up the bargains, because now come February, March, if banks announce the kind of results we saw in Q3, in February, March, and the sort of dividends we think would be a signal, I think will be for signaling, especially because it's an election year. Remember, Kenya is a very dividend-oriented, the Kenyan investor is a very dividend-oriented investor. Yes. I have a lot of them calling me and saying, how come I didn't receive my dividends? They don't realize the dividends were not paid by several of the companies they hold. So if that happens and there's a lot of dividends or good dividend payouts, then it would mean it would push a rally, maybe during the early part of the year, maybe for to feed a bit on Kevin's pessimism, maybe towards the election we might see a bit of a slowdown, which we saw in 2013, I think 2007, we did see towards the election itself, the market sort of tended to slow, but it did rally earlier on in the year. So I would expect if we're going to get a good dividend year, we might see a good move between March and June.
Okay. Yeah. Kevin, I'll close with you. I know you already have a comment on that, but I want you to also add and move and talk about the top movers. Of course, it's the usual suspects. We have this Safaricom, KPLC. Interesting is there, ABSA, KenGen, and KCB as well. On top of that,
it's just what I wanted to add. He added on to my pessimism. I'll add on to his optimism. And I think he says he saw a peak in or sometime around September. Yeah. I think partly it's due to the companies that actually declared a dividend. We've seen quite some book closures falling around November, end of November, early December. I think we have 2 companies that are closing tomorrow. I think one of it is NSE itself, 0.5 shilling interim dividend. It's almost 8-9%. It's a really good dividend. So I think the declarations of the few companies that actually declared a dividend also brought that, that boost in the stock market. And there was an expectation that, having come from a full year of the pandemic, the blue chips, your equity, your KCB, your ABSAs will actually declare a dividend. Well, there's the optimism that, yes, they didn't declare for a whole full year and they're going to declare now sometime around, I think it's March. February, March. They're going to declare, but it's not to disapprove him.
I was looking for the but.
Yes, it's not to disapprove him, but I think coming now into an election year where the banks don't know, okay, do we give our money to do we buy government debt? So do we invest in bonds? Or do we then pull off this money from government debt and lend it to the Mwananchi? So the banks will be at at a very difficult place. They'll be in between a wall and a really hard place, where you don't know what to do with the capital. And then that's for that reason, I think they will want to preserve as much capital as possible.
Yeah.
I'm not optimistic they're going to give a dividend. If I was a CEO or an executive of one of the local banks, I don't think I would give a dividend.
You'd hold
Having
back.
going
Yeah.
just a few months into the elections, I would withhold that money.
Yeah.
I better give a special dividend through an AGM after the elections.
Okay.
Yeah.
All right, there you have it. Some interesting perspectives there. I would want to end with this. You know, this is a Christmas season, as we have said. I would want you to give a tip here and there. And by the way, also answer this question for me. From your observation, did we see greater interest in the markets from especially retailers this time round? Would you say there was a bit of an upscale, or it was still stagnant? And what's your hope for next year? So those are so many things to say in one. But yes, your observation in terms of uptake in the markets and in terms of the participation, and your message for Christmas to the people. Let me start with you, Gisho.
Yeah, as I said earlier, because of all the idle capital, retail really supported the market. As Kevin said, we can't completely support the market.
Okay.
But considering the level of foreign sell-offs we saw when the COVID pandemic came, the expectation was the market would go much lower than it actually did.
Yeah.
And at some point, even for us, it was doom.
Yeah.
But yes, the retail investor did step up, and we saw a lot of. And I'm thinking, if you look at things like the flower industries, sort of went stop. The hospitality industry stop. So many things just stopped.
Yeah.
And suddenly we had a lot of people with idle capital, because this was the money they had cash they were using for working capital and all that, and now they had it in cash, and so they needed someone to pack it, and we did see quite a lot of that come to the stock market.
Okay.
Obviously, as the market opens up, then we can expect to see them probably sell off some of what they're holding, and so that could actually go to what Kevin is saying. You could see a bit of a downturn, but remember, markets work on the sort of turnover that is happening.
Your Christmas message.
That's it. My Christmas message. Don't spend what you don't have.
Okay.
Yeah. Don't take credit. So just spend wisely.
Yeah.
Spend what you have. The thing is, people will have only 1 week. Children are going on holiday for 1 week.
Yeah.
So this is a year where you can save what you usually spend for Christmas.
For Christmas, yes.
Pay school fees, and at least start the year with some extra money that you can invest.
Kevin, how about you?
So I think in terms of retail participation, or generally, you and I participating in the local market, I think we've seen quite some uptick if you compare it to previous years. In part, I'd like to thank that to automation. Yeah. I think we've seen quite some automation of processes, processes that could take a week, 2 weeks. Opening of CDS accounts nowadays are almost instantaneous.
Lovely.
It's like opening a bank account, You come to a company like us, Jengis, and you have a Jikuze app where from the comfort of your seat, you can just sit and invest. So I think, seamlessly. And you can use your mobile money providers to send money and receive money to your account instantly. So I think that automation has been a big foot. And let's get it clear. We can get so many things right, but we don't have the laxative to get the stock exchange wrong. So we really have to push it. I think we are headed in the right direction. NSE will try and throw us a bone here and there. Might be sweet, might be just there like the day trading. But I think together we are really taking strides. For Christmas, I think it's just tell folks that we've survived this far. Glad tidings and happy holidays.
Lovely. Good way to end, at least very optimistic this time around in the house. That's we had Samuel Gishohi, NCBA Investment Bank, Head of Business Development, and Kevin Gigi, Head of Equities, Jengis Capital, right here, helping us understand how the market was and a look at how we're crossing over. I think generally there was some good energy and, some good advice as well for you for your Christmas. So from my end as well is to wish you a Merry Christmas and a Happy New Year. See you next year. Of course, be wise, spend wisely. It's only 1 week, as Gishohi has said it. And of course, enjoy your time. Bye-bye for now. Trading Bell.